While the Eurozone's debt problems may be out of the way for the moment at least, and certainly the downgrade coming through from Moody's illustrative of that, you've got the continued ability or inability rather of US politicians to reach a budget deal, keeping the markets nervous more so than anything else. What's your assessment of the current landscape and implication for risk on bets?
Look, I think at the moment it's really a story around the US, and unfortunately that scenario is boding very, very negatively for the US dollar specifically. So you've seen the gold rally, you've seen the euro rally, the rally's up to 144 again. The rand's remaining relatively strong as an emerging market, and most currencies are quite strong against the dollar because of this uncertainty, as well as the fact that they are likely to increase that ceiling. You know, there's a lot of political underwater things that are happening. So there's the Democrats against the Republicans, a lot of noise in the system as we're in a very, very politically charged environment. And those sort of things don't really bode well in terms of the sentiment around the US, and obviously the potential that they may just be downgraded. So there's a lot of nervousness and a lot of chatter around that, but I think ultimately that debt ceiling will be increased. It's just something that has to happen. The more important thing is how they're going to handle the debt ceiling going forward, how they're going to then potentially try and sort out their debt issues, you know, what that spending cut scenario is going to look like in this politically charged environment. And these are things that are going to play out over the next couple of months.
And whether that will be an answer to the markets or provide answers to the markets is also out there, because I mean we've seen, as is the case over in Greece, that even when some kind of package is put on the table, there are big question marks around sustainability of that and what that really means moving forward in terms of economic growth.
Well, you know, it's been quite interesting. I mean, we talk about the Eurozone and the US as the two ugly sisters. And ultimately, I mean, if you see what's happening in the Eurozone, despite the fact that we've had these peripheral issues that have continued to cause uncertainty, etc., what's starting to happen is the markets getting their head around the fact that although Greece is, technically in a default, the reality is that the German business sector and their economy are going to come to the rescue and potentially will buy up those bonds in one form or the other. So that economy will be supported. You know, they're looking at the protection of their interest rates, or their, having to repay their debt, etc. So there's a lot of things that are happening in that scenario, but it seems as though the market's a lot more comfortable with the outcome there than what's happening in the US. And the uncertainty around the US now, specifically with the fact that they're at the top of their debt ceiling, they're not handling the situation well, is really not going down well at all in terms of how markets are perceiving this outcome. And then if we look at the rand, I mean, the rand's continue to behave relatively well, still trading at 680. So we're remaining now this week, I think, within a range of sort of 672 to 685. We just expect to see continued interest in our local bond market. The bigger risk really does lie around the equities, because we've seen equities falter across Asian regions this morning. There's a lot of concern around the equity markets potentially starting to get to the top of their momentum indicators, and what the outcome of that's going to be. So I think that's possibly where the risk lies on the rand, but for now, relatively strong.
Of course, we've also got key data points that the markets will be tuned to. I mean, last week figures continued to point to this rapid deceleration in global growth, and with that, we've got the highlight on the data calendar this week being the US second quarter GDP figure, which is out on Friday. What are your expectations there?
We're expecting that to disappoint slightly. We are expecting that to come in line with the rest of the globe, where the GDP numbers have not been, seen that significant growth that a lot of market participants have been looking for at the beginning of the year. Slowly, expectations are being eroded, and you're starting to see GDP forecasts coming in as less than expected. And I think that that's something that we're potentially going to see as we go in towards the end of the year. I mean, we saw our own MPC talking about it last week, Thursday, just concerned around the risks around global growth and the impact on our local market. You know, global growth, unfortunately, with unemployment, with the huge debt levels on households, the money not really being passed through from banks within that low interest rate environment into the household and into the consumer, is really putting pressure on economies across the globe. And I mean, it is something that is going to impact us here in South Africa, as we've seen across the curve. And I mean, even if you're looking at the likes of China, the outcome with regards to the aggressiveness or the momentum for growth is starting to slow down.
So having said that, Brigid, and with so much of the focus abroad, I mean, how does the local economic data that we're anticipating this week, and of course local risk that presents itself with all the strike action that we're continuing to see persist, factor in?
Look, I think that, you know, what you're dealing with at the moment is you're talking about two different things. You've got the short-term hot money, which is investor sentiment that comes from offshore players, looking at our local bonds for some yield carry, you know, looking at opportunity because of the fact that the rand's remaining relatively range-bound. Then you've got the longer-term FDI flows, and I think that that's where the real risk is. With the underlying issues around what's happening with this debacle around Walmart, Massmart deal, the wage negotiations that are currently going on, talks about nationalising mines, the likelihood of you know, the fuel strikes, etc., which don't really bode that well in an environment where you really want to have some form of long sustainable investment that's for the next 20 years, that boosts our local economy. And I think that's really ultimately, from a foreign investor perspective, specifically now as we're going also ourselves into a politically charged year next year, bodes an upside risk for us not seeing that kind of long-term investment flow, where we're in an environment where potentially wages are not that attractive in terms of production costs, where we've got a lot of underlying issues that remain in the system, and these, you know, these fuel issues, the strike action, they don't bode that well in terms of an investor from offshore looking at the local landscape as an investment opportunity. But the short-term money will remain. You're still getting a 3.5% real yield, so we'll definitely see that remain for the foreseeable future until interest rates start seeing hikes from offshore.